Secretary of Treasury on the state of the international finance system. I now recognize myself for 5 minutes to give an opening statement. Whether you are looking at unemployment, disposable family income, GDP, small business optimism, you name it, it is clear that many, if not most Americans, are enjoying the very best economy of their entire lifetimes. And no man is more responsible than President Donald Trump. However, if we find ourselves mired in a full-fledged global trade war with no end in sight, all of the economic gains he has helped bring us may well be lost. I've heard the President boldly call for the elimination of global tariffs. I enthusiastically applaud the President for doing so. However, I also continue to hear talk from the administration of, quote, ending trade deficits and, quote, imposing reciprocal trade policies. These are not identical goals to reducing trade barriers. For example, we could end trade deficits tomorrow by simply outlawing trade, and then watch as GDP and disposable family income plummet. With respect to reciprocal trade agreements, just because other nations punish their consumers with tariffs doesn't mean we should necessarily follow suit. Because at the end of the day, a tariff is a tax that is usually passed on to the consumer. So for the example, when the administration first announced their tariffs on steel, aluminum, and washing machines earlier this year, it became more expensive for working Americans to share a six-pack with their friends at the local laundromat. And as of last Friday, when the administration announced $34 billion in tariffs on an array of Chinese goods, including auto parts, it also became more expensive to work on your car in the same laundromat parking lot. And now, with an additional $200 billion in tariffs announced, who knows whether the laundromat will even be here at year's end. As my constituent Chris in Mesquite, Texas, wrote me about tariffs, quote, I'm now facing increased cost in auto parts and housing. It can't get any closer to home than that. Not only do tariffs harm American consumers, they harm many American employers and their American workers as well, since over half of our imports are intermediate components or raw materials for American businesses. As my constituent Elizabeth from Dallas wrote me, quote, I am a metal manufacturer. Since the tariff talk began in February, I have seen major increases, well over 25% from steel vendors and the mills. Soon my end users won't be able to afford the cost of our products. I may have to actually lay off workers, unquote. This is the voice of but one American business, but she undoubtedly speaks for many. Tariffs can also damage entire industries, including strategic ones like our domestic energy industry. For most of my life, America has been energy dependent. Now we're on the cusp of producing more oil than any country in the world. But the oil and gas industry imports specialty steel and aluminum for pipelines, wells, and other infrastructures. The tariffs may just harm our ability to remain energy independent. And I've yet to speak of the retaliatory tariffs of the EU, Canada, Mexico, and China. Needless to say, it's a bad time to be an American SUV producer or an American soybean farmer. As soybean prices have dropped to their lowest level in almost a decade, one farmer said about his family farm, quote, that's $100,000 that has disappeared into thin air. We were already in the red, now it's even worse, unquote. We have known since the days of Adam Smith and David Ricardo that trade is a win-win situation. No trade, in contrast, is a lose-lose situation. I understand that our trading partners have more to lose than we do because their economies are far more export-dependent, but losing less is not the same as winning more. When the dust finally settles, the administration's trade policy may prove to be brilliant. I hope so. With patience, short-term pain may pay off in long-term gain if tariff and non-tariff trade barriers are actually reduced. But in the meantime, CapEx checkbooks are closing and expansion plans are being put on hold as growing uncertainty creeps throughout our economy. So I hope it is time that we get on with it. I would respectfully call upon the administration to concentrate time, resources, diplomacy on those nations that consistently violate WTO guidelines and force involuntary IP and technology transfers. In other words, it is the moment we should be uniting with our traditional allies to confront China. I would also call upon the administration to drop any effort to unilaterally impose auto tariffs under Section 232. The 11-year-old Honda Accord I drove to work today in simply does not threaten national security, nor does any other imported vehicle. I fear further efforts in this regard are counterproductive and will simply undermine the administration's credibility. I do wish, though, to compliment the President and Secretary Mnuchin for working with Congress on vital CFIUS reform. Thanks to the leadership of Mr. Pittenger, Mr. Heck, Mr. Barr, and the ranking member, the House's bill was passed 400-2, and we look forward to going to conference with the Senate. This shows how the administration and Congress and both parties can work together on shared trade goals. The administration should continue to work collaboratively with Congress on trade, and yesterday's Senate 88-11 vote is indicative of its importance. I now yield 3 minutes to the ranking member for an opening statement.
Thank you very much, Mr. Chairman. I'm looking forward to hearing Secretary Mnuchin's testimony today on the state of the international financial system. I must admit that I was surprised to learn that the Trump administration had agreed to back a $13 billion capital increase for the World Bank and the IFC, that is the International Monetary Fund. This positive step is a notable departure from the Trump administration's unprecedented and harmful approach to multilateral agreement. However, it would be a serious mistake for the World Bank to take my support for this capital increase for granted. I'm extremely concerned about the bank's recent recommendations in its upcoming World Development Report for the wide-scale dismantling of regulations protecting workers, including lower minimum wages and greater firing powers, particularly in developing countries. The World Bank should not be rewriting the social compact to recast the balance of power between labor and capital. This will lead to greater inequality and undermine social cohesion and ultimately harm the bank's legitimacy and relevance in the fight against global poverty. That said, Mr. Chairman, while I do appreciate the administration's support of the World Bank, I'm very concerned about the actions this administration has taken in many other areas that fall into the purview of the Treasury Secretary. As we meet here today, the Trump administration is waging a trade war that will have wide-ranging economic consequences. Last week, Mid-Continental Nail, America's largest nail manufacturer, laid off 60 workers and announced that the whole company would go out of business by Labor Day. Volvo no longer plans to hire 4,000 workers in South Carolina. The U.S. Chamber of Commerce is warning that 2.6 million jobs are at risk. Hard-working Americans are already suffering as a result of the retaliatory tariffs provoked by the ensuing economic uncertainty caused by this president. Moreover, this trade war comes at a time when our deficit has ballooned due to the Republican tax law, which has been nothing more than a giveaway to very wealthy individuals, Wall Street banks, and big corporations. I look forward to hearing Secretary Mnuchin address the adverse impact this administration's policies are having and will have on small businesses and consumers, and I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, ranking member of the Monetary Policy and Trade Subcommittee, for 2 minutes.
Thank you so much, Mr. Chairman, and I want to welcome Secretary Mnuchin back to the committee. I appreciate your reply to my letter that I sent of May 17th. You replied just recently. The letter was related to the transfer of the Universal Service Fund to the Department of Treasury. So I look forward to your testimony, but during the Q&A, we've already alerted your staff so that you could be prepared for my questions. There are outstanding issues service fund that are important to both my urban constituents and rural constituents of many of my Republican colleagues here who really rely on these services. Like the Rural Health Care Program, the Connect America Fund, and in my district, there are over 50,000 households that subscribe to the Lifeline, just one of the programs that's supported. And as you know, it connects disabled people, poor people with jobs and with healthcare assets. I'm going to appreciate hearing a detailed explanation of the regulations, resources, and staff you've put in place to ensure that the FCC continues to use these funds to provide telecommunications access to Americans, and assurance from you that these services will not be disrupted. The specific funds that you've deposited into the Treasury account and the funds that you're still waiting to be transferred that you refer to in your letter, and how you plan to make up for the loss of interest that the funds were in interest-bearing accounts in the private sector when they were there, and how you're going to make up the deficit so that there won't be any lapse in ability to serve those constituents. And so I look forward to your testimony, Mr. Secretary, and I yield back the plethora of time that I have.
Gentlelady yields back. Today we welcome back to the committee for his third appearance the Honorable Stephen Mnuchin, Secretary of the U.S. Department of Treasury. Secretary Mnuchin has previously testified before this committee, and so because of that, I believe he needs no further introduction. Without objection, the witness's written statement will be made part of the committee record. Secretary Mnuchin, welcome again, and you are now recognized to give an oral presentation of your testimony. Thank you.
Thank you. Chairman Hensarling, Ranking Member Waters, and members of the committee. It is good to be here with you today to discuss the National Advisory Council on International Monetary and Financial Policies report to Congress and other priorities of the Treasury Department. The NAC report highlights international financial institutions' roles in encouraging global macroeconomic growth and financial stability, advancing U.S. national security priorities, supporting the development of markets for U.S. business, and working to alleviate poverty. The Treasury has promoted reforms at the IFIs to help them better contribute to these objectives, and we will continue our efforts to increase the IFI's effectiveness and value to taxpayers. I would like to note that the International Monetary Fund's periodic review of quotas is scheduled to be concluded next year. Every 5 years, the fund reviews its financial resources and decides whether to increase them. At this time, the United States finds that the IMF's overall resources are adequate following the 2016 implementation of the 2010 quota and governance reforms. I also want to highlight the strength of the U.S. economy. We continue to implement President Trump's economic agenda focused on tax cuts, regulatory reform, and trade. In only 6 months since the passage of the Tax Cuts and Jobs Act, Americans are seeing faster GDP growth, more money in their paychecks, and better career opportunities. Unemployment numbers are historically low, with an average of over 200,000 jobs added each month of the second quarter this year. Over 500 companies have announced bonuses, wage increases, and enhanced benefits. The National Federation of Independent Business, the National Association of Manufacturers, and the Consumer Confidence Index are all at reporting record levels of optimism. Americans are keeping more of their hard-earned money, and U.S. business is more competitive. Our efforts to eliminate unnecessary burdensome regulations are also having a tremendous impact. We have worked closely with this committee and others in Congress, as well as our colleagues across the administration, to create a regulatory environment that is more efficient and predictable for business. These reforms are enhancing the flow of credit and supporting job creation and wage growth. At the same time, we remain committed to ensuring the stability of the financial system and protecting taxpayers and consumers. Our tax and regulatory reform agenda complements our trade efforts. We strongly